You have probably heard the buzz. Mega investors are snapping up swaths of single-family homes, leaving regular home buyers worried and sparking headlines about an affordability crisis. But what's really happening behind the noise? In this video, we are breaking it all down. Who these investors are, why they are buying so aggressively, the impact on your neighborhood, and most importantly, what you can actually do about it. By the end, you will understand the numbers, the real-world effects, and the moves you can make in response. Let's dive in. Investor buy-ups are surging. Here is the reality. Investor purchases of homes have hit a 5-year high. In Q1 2025 alone, roughly 27% of all U.S. home sales went to investors. To put that in perspective, the 2020 to 2023 average was about 18.5%. That's a huge jump in just a few years. And we are not talking about random buys here. Early 2025 data shows investors, from small landlords to institutional giants, captured up to 32% of all single-family home purchases in markets like Atlanta, Memphis, and Los Angeles. Why? Because they have a competitive edge. Cash offers, no contingencies, quick closings, things traditional home buyers often can't match. When homes hit the market, these investors swoop in fast, writing checks while regular buyers scramble for mortgages. The result? Entire neighborhoods are seeing homes shift from owner-occupied to investor-owned portfolios seemingly overnight. Who are these mega investors, really? Here is the interesting part. Despite the headlines, giant institutional investors, those owning 1,000 or more homes, still represent a small fraction overall. About 2.2% of all investor-owned properties fall into this mega category. But before you relax, consider this. Their footprint has more than doubled since early 2023, when they made up just 1% of investor buyers. Meanwhile, mom-and-pop investors, the landlords owning 1 or 2 properties, still make up about 85% of all investor-owned homes. They dominate in sheer numbers, but not always in speed or capital firepower. And location matters. In Atlanta, institutional investors now own 10% of single-family homes, transforming entire zip codes into rental-heavy neighborhoods. So while mega investors remain a sliver nationally, in some cities their influence is anything but small. Why the surge now? Let's talk about timing. Why is this happening in 2025? There are 3 main reasons. 1. High mortgage rates plus home prices. Regular home buyers struggle with affordability. Investors with cash or bulk financing face fewer barriers to entry. 2. Liquidity advantage. Big investors bring institutional money. They can buy entire blocks while families scrape for down payments. 3. Rental demand. With many locked out of homeownership, rental demand stays strong, ensuring steady returns for investors holding properties long-term. Take Memphis. Homes average around $340,000. Crime rates are high, but rental yields are excellent. That combination is catnip for investors seeking cash flow over appreciation. Or Atlanta, where rapid job growth, migration, and prior investor waves have built a perfect storm for continued buying sprees. This isn't random buying. It's strategic, data-driven, and focused on markets where demographics meet opportunity. Why should you care? 1. If you are a first-time buyer, here's the tough truth. Competing against all-cash investor offers, it's an uphill battle. 2. If you are a seller, those cash offers may seem like a dream. Fast closings, no contingencies. But sometimes, traditional buyers offer better prices, so don't jump too quickly. 3. If you are a landlord or developer, this surge creates new options. Bulk sales, JV partnerships, faster lease-ups. But there is a flip side. As investor control grows, home ownership rates drop, wealth gaps widen, and eviction risk rises in some communities. That's why lawmakers at city, state, even federal levels are starting to pay attention. Policymakers, step in. In Texas, a bill proposed capping investor purchases by banning companies owning 25-plus homes from buying more. It stalled, but expect similar proposals nationwide. The Federal Trade Commission recently launched studies under Section 6B to examine whether mega investor dominance raises rents or inflates housing prices. some local leaders in Atlanta are already trying to restrict large investors from buying to protect affordability for families. This isn't just a housing story anymore. It's about economic equity, community stability, and who controls America's neighborhoods in the next decade. Myth versus reality. Now, let's separate myth from reality. Mega investors aren't buying every home. According to JBREC, their share peaked at 2.4% of home sales in Q2 2022 before dropping to 0.3% in Q3 2024. Overall, investors, small and large combined, average 18% of the market, with mega players hovering around 1% nationally. But remember, even 10% ownership in one metro like Atlanta can reshape prices, rents, and long-term ownership trends locally. What can you do? For home buyers, 1. Track investor activity in your zip code. 2. Get pre-approved early. 3. Use appraisal gap coverage or inspection flexibility when possible. For investors, target metros balancing rental demand with lighter regulatory risk. Places like Memphis, Oklahoma City, and parts of Texas still shine. And for everyone, the mega investor trend isn't a Hollywood villain takeover, but it is reshaping access to real estate, the #1 wealth-building tool for most Americans. To recap, investor purchases now claim over 1 in 4 U.S. homes. Mega investors remain a minority, but concentrate power in key metros. Policy, affordability, and market access are all at stake as this trend grows. Want data on your local market? Need help crafting competitive offers or structuring investments in this environment? Book for Investor Impact Playbook or book a strategy call at gavtax.com right now. Don't forget to like, subscribe, and hit the bell icon because the housing market's next big shift is already unfolding and you will want to stay ahead.